All right, next question is financing. You all had, you know, different ways. I should say acquisition is probably a better way to say it. People sometimes use cash. People use self-directed IRAs, private money, conventional loans. If you would just let us know how you were able to get started and acquire.
Well, we had a little cash that we started first, but more than that, we sold our house in Virginia, our condo in Virginia, and we didn't even 1031 it. And that was probably pretty good, being that we took a loss.
Okay.
We took a loss, and even after everything settled out, we still came out ahead. We've already gotten back the money that we lost in cash flow.
Wow.
Yeah,
great.
so we bought at the top of the market. We sold.
Bought
it.
And you said the new strategy is a different one. Just the one we did before.
Yeah, so we're working on it. But, and there was enough cash flow there to make things work, and there was enough. We owned the place outright, which was another reason why we didn't. Our OI was 3%.
Okay.
So that's a lot of money to tie up and not make money on, right?
Right.
So that's where we're going. That was our strategy, to start making money.
So the first properties you bought, it was from selling the not so lucrative property in Virginia.
Correct.
And you didn't exchange it, but you just sold it at a loss. And how many properties were you able to buy? Did you finance? Did you use that money as down payment? So you financed it?
Yes. I don't know, actually, because we bundled that with, you know, we had some other cash that, you know, the bank, or we just kind of looked at everything, we put it all together, but that was the big chunk of it. And we just went out to as many houses as we could get starting off. And our first signing with a mobile notary and a coffee shop was on 6 houses. I think
6 houses
that's
was your first purchase.
Right,
I want to put on the record, I do not recommend that.
As your first? six closings in one sitting.
Yeah. And then,
wow. Okay.
There's a little background on that, though. Okay, that was not the
Rich
crazy.
and I did that too, just so you know.
It was not Crazy Maker's fault, though.
It was definitely Crazy Maker's fault.
Yeah, we were working together on that. So we had, I was on my way, you know, exiting the military, and we were stationed in Japan at the time. And we were on a trip, of all places, Australia. And on the way out the door, my wife bought me a book on real estate investing. And some of the takeaways from the book were cash flow properties aren't necessarily the property you want to live in, but if it's a good quality product and you're providing something for people that they need, you may not want to live there, but people do want to live there as long as it's a nice place. So that was a different concept for me to grasp. And then I started looking at the market because she was giving me information. And as I started analyzing, I'm like, oh my gosh, we're going to miss this opportunity. So I was like, you know, the best place to build a hamburger stand is when you have a bunch of hungry people. And I'm like, man, I can't wait to get back to the States. We need to do something. I was concerned we were going to miss this opportunity just because I think it's the only time in history where both prices and interest rates dropped down really, really low at the same time. I may be wrong on that, don't quote me. But from my knowledge, I'm like, I could never remember it being like that. So I go, you know, this is one of those opportunities that won't last forever. So we were a little bit more eager than maybe the average bear when it comes to that part.
Okay, so you were able to buy 5 at first, and then subsequently the properties you bought were from the cash flow from those?
Not yet.
Okay.
Not yet. I mean, this is our first. I mean, yes, we
pulled
pulled
that
money.
You're expecting.
Right, we're expecting, but we did pull that money. We did repurpose the money as it came in. We definitely moved it out. We made sure we had our buckets. Once we got our buckets in place to protect us from stuff that just happens in life. What do they say, 3,000 to 5,000 per property, you know, more or less. And that's it. It's kind of simple from that point.
Okay, great. What about you?
So we, again, initially we started with refinancing our house, pulling money out of that, using that as a means of a down payment for properties here in the Bay Area.
So you did a cash out refinance, or you got an equity line?
Not an equity line. We potentially wanted to do a cash out refinance. Did that, and then from there, purchased some properties, got some other loans, conventional loans for the properties that we purchased in Indianapolis and Ohio. And again, the Ohio property was a 1031 exchange, so and it's a little bit complex, 1031 exchanges, but the bottom line is we got to take the cash that we had from our sale and put that all into purchases of the 5 properties in Ohio. So we ended up with a 50% down on 5 properties and loans of only 50%. So we had actually very high cash flow as a result. That's not normal. Normally we'll buy a property at 20 to 25% down. But that's the way we financed it.
Okay, great. And anybody new to Real Wealth Network, you might not know that you can get conventional loans. You can get up to 10 loans per person through Fannie and Freddie. So I'm assuming that's what you did. Okay, and separately, did you put them in?
Yes.
Yeah.
Yes, and actually we came to a point where we weren't sure about getting rid of our property that we had here in the area because we were both on that note, and then we sold it. That opened it up and allowed me to purchase another property with that.
Oh, right, okay. Yeah, so.
Yeah, let me, and I wanted to share one experience that we had that you should take note of. And that is, if you have a trust and you want to buy a property with a trust, and you're on the trust with a partner or husband, wife, whatever, that's considered 2 people on one loan.
Yeah.
So when you're buying, and to Kathy's point, you can get 10 per person. You got to make sure it's set up properly. We made the mistake of buying some properties with a trust and found out that, oh, that's considered 2 loans or 2 names on that one loan. So that kind of takes you out of the ability of getting 20 properties from 2 partners. So I'm just saying that before you get a loan, before you're buying something, talk to the advisor you're getting the loan from. Make sure you have it under the right terminology.
Yeah, if you're concerned at all about, I mean, you know, California law is 50-50 anyway, but you can add your spouse on the title later after close.
Correct.
Yeah.
But don't do it when you're
Don't put your spouse on the loan. Yeah. Okay. Wes, financing.
Financing.
I've already gone over it a little bit.
Yeah, to best accomplish my business plan, which is to maximize income that's flowing from these properties, I did that most effectively by mortgaging them as much as I could. It's a really simple concept, but I'll just say it anyway because there might be a few of you who don't know it. But if you have $100,000 to invest and you buy a house for $100,000 and you pay cash because you don't want to worry about having to make payments on it, you maybe get $1,000 a month in rent. But if you take that same $100,000 and you buy 5 houses for $100,000 each, and you put down only 20% on each one of them, you've spent the same amount of money out of pocket, but now you're getting $5,000 a month in income. And so that's why it makes sense to me to use the bank's money. The bank's doing 4/5 of this, but I get all the profit. It's one of those things, it's almost too good to be true. It seems like if the bank's putting up 4/5 of the money, that you should have to share with them. But they make all their money on that little percentage on their mortgages, and you get to keep all of it. You get to keep all the cash flow, and you get to keep any appreciation that happens in that property. And yet, you only really own 20 or 25% of it. So that's my strategy. I don't want to tie up a whole bunch of money just so that I can own something free and clear. And you can get really high returns doing this on the homes. The 10 homes that I bought, I'm receiving, the least I'm getting is 18% on one of them, but I have 3 of them that I'm getting over 30% based on the down payment. So if I put, just as an example, $20,000 down on a property, and I'm getting 25%, that means that I'm making $5,000 a year on that 20,000. So after only 4 years, I've paid off my down payment, and everything after that is just free money. And interest rates are so low now that the little bit that you're paying in interest, it's not even really worth worrying about that. Take the money and do something with it.
And that could change quickly. I mean, there's obviously a lot of different opinions on where interest rates are headed. But in the past, it could go up dramatically, up 1 point, 1% every time they meet. So every 3 to 4 months, you could be seeing an interest rate hike of 1%. So it's really easy to get comfortable with where we are and think it's normal. And there's nothing normal about today's interest rates. They are historically low. And
But what's cool about them is you could lock them in for 30 years,
Right.
regardless of what the rest of the
And there's no other country that does such a thing. There's, you know, if you read my blog, I got back from Australia, and they would love to be you. They would love to be sitting in your seat right now with the opportunity to get U.S. financing, and they can't. And there's no other country that would offer such a thing because it makes no financial sense. Would you lend somebody $100,000 and not want it back for 30 years at 3, 4%? Of course not. That is subsidized. And so if you are an American citizen paying taxes, you're basically paying for that either way. So you might as well take advantage and use it, right? And it's not going to be here forever. Right. And the same with these home prices. You know, we're saying today $100,000 for properties. We're using that as an average. We've got markets that are still in the $60,000, $70,000, $80,000 range. Rich and I started investing in 2004. Believe me, we weren't buying $100,000 properties. We were so excited when we could get them for $150,000, right? And so, again, it's just when you've been sitting in this environment for so long, you think it's normal. It's really not. So it's time to move. If you haven't yet, and I don't want anyone jumping in and not knowing what you're doing, but when I say it's time to move, I mean get informed, get the education you need. Our website's full of it, the room's full of it, you're full of it. All right, Ben, hi Nancy, anything different than?
Well, I mean, I bought a couple of the El Cheapo houses, all cash, but most of them are financed with Fannie, Freddie, or the ones I have in Cincinnati are through a traditional IRA, so I had to pony up, and this was a couple years ago where the banks were a little more nervous than they are now, so I had to put 60% down. So the non-recourse financing that you have to get with IRAs, they would only loan me 40%, but still, that's better than 100%. It allowed me to get 3 instead of 1.5 houses. So, so I've got 1 house in an IRA that's a Roth, and then 3 that's in a traditional, so I'm kind of done with that, unless I somehow turn them into more houses, which I'm trying to do. And now I'm going to focus on the Fannie Freddie slots.
Right. So for Rich and I, we were not in a position to get more loans, and yet we had a family member, who's, since this is recorded, I won't say any more than that, who was too nervous about investing in real estate, but wanted to be in it somehow. But at her age, it wasn't maybe appropriate. And so I went to her and said, how about you, instead of being in bonds, which to me is quite risky, how about we give you a much better return than bonds, and now your money's secured to something tangible, so you're in real estate now, but you don't have to be a landlord. I'll borrow the money, I'll be the landlord, and you're going to get a much better return. And she was so happy. So, so we were able to, you know, and I went way over. I didn't need to pay this much, but I pay her 8% because I love her, and it's helping her, and we still cash flow. So even if you can't qualify for financing, or you're past the 20 loans, or you've had a short sale of foreclosure or anything like that, but you have an opportunity to help someone else, you know, because from my perspective, I wanted her out of bonds. I didn't want all of her money in Wall Street, let's just put it that way.
Yep.
And so, so this was a way to help diversify without her being a landlord. She gets a great return and I get a loan. So, all right. So moving on to the third, this is probably going to take even longer, or maybe not, I don't know. Third is due diligence and systems. So what did you do to make sure, we have a large array of affiliates to work with, and we're just one company. There's many companies out there. There's real estate agents everywhere. There's hundreds of cities in the US. So what had you decide, this team, this market, this company, and what due diligence went into that? So Wes, we'll start with you.
Well, I kind of already spoke to that.
You did.
When I came to this, I literally knew nothing about real estate investing. I knew that it seemed like a smart thing to do, but I didn't know where to go or what to do. These guys have everything you need to know. I've not gotten one piece of information from another source beyond the Real Wealth Network. Now, other people might feel a need for that, but I feel I got everything I needed. I went to not very many, 2 or 3 seminars. I listened to what the philosophy was behind this thing, and it made sense to me. I didn't see anything wrong with it. So Kathy asked me on the radio, if there was one piece of advice I would give people. And my one piece of advice is to be bold and don't procrastinate, because this is a unique point in time. Interest rates are really low, and there's a lot of markets still, not a lot, there's some markets still left in the country where home prices haven't really appreciated. And those two things are presenting a great opportunity that's not going to be here for that much longer. So I would say come to some of these lectures, look at some of the recorded ones, but there isn't that much stuff to know. And go to a city and meet some people, and a couple of people have mentioned Missy. That's a great place to start because everybody loves her, and she just comes across as being so genuine and honest. And she'll walk you through the whole thing. But I mean, it's easy. It's not that hard. And so you got to get started. Buy one house, and see what happens. And I bet that within just like 2 or 3 months, you'll already have enough experience to say, hey, this works. I'm ready to buy another one.
Well put.
Well,
Well, strategy, I agree with a lot of what Wes just mentioned. And to just add on top of that, some of the things I would highly encourage is, number one, first get yourself educated. Feel comfortable with what has been discussed. Definitely listen to the webinars. They're recorded. If you can't make a Thursday at noontime, at least do it on the weekends in your free time. Take notes. Listen to what people have to say. You'll hear a lot of commonalities through these sessions. That's one piece I would say is educate yourself. Secondly, I agree with Wes, and that is now's the time to do it. Don't procrastinate. Once you make a decision, go with it. You don't have to go hog wild. I also agree, maybe you do one home in the market and see what happens. But the things that we did strategy-wise, or I should say really in terms of reference perspective, is number one, I'll highly recommend you speak with somebody like Ben with what your strategy is. Here's what we're thinking about. What do you think? What are some of the markets you're recommending? Where's the market hot? Where's the market's cold? I mean, what's going on out there? Do a one-on-one. If you can't do it face-to-face, do a phone call. But that way you have undivided attention with somebody that can listen to you and be really an advisor for you. So if you feel uncomfortable, ask those questions. Once you get past that point, it's the due diligence of you got to go out to the locations that you're going to be considering. Even if you don't buy there, go out, pay the money for the flight, for the hotel. look at the property management, the company that you're going to be dealing with. I'd say the same thing. When I met Missy, we spent the whole day together. I mean, I was ragged at the end of the day. She went and looked at 20 properties. She even said to me, you know what? Within 2 or 3 weeks, more than likely they'll all be sold. And sure enough, we offered, put a couple offers in. We didn't get any of them. But the point was, we at least knew what was in the market. We met her management team. We met everybody in her organization. Highly recommend that. It's just like anything. What you hear and what you see are one thing, but you have to meet people face to face. You've got to make sure the chemistry's right. If the chemistry's not right, back off, get away. Not every property management company or any affiliate out there is going to work for you. Some will work better than others. The other thing is, highly recommend that you get names of investors in these various marketplaces from Real Wealth Network, who are some of the investors that invest in these markets. Call them up, speak to them, email. I met one gentleman in Australia, and we did emails back and forth. We did Skype back and forth. Told me what worked, what didn't work. But the point is, educate yourself as much as possible, so when you make the decision, you can at least sit here and say, I've done all my homework. And it doesn't end there, and this is one of the things I really encourage everybody to make a note of, is that once you make a purchase, it's not done. You have to manage this, okay? Period. You have to manage it. You can't just walk away and think, oh, I'm going to get my check every month in my ACH deposit. No, you got to manage it. You got to make sure your statements are correct. You got to make sure that the properties are being maintained. So one of the things that we do is, at least I do, is I go out and visit every property at least once a year. I go and I had a tour. I ask to be shown the inside of the property, the exterior of the property, and I actually ask to meet the actual renter if they're available, and to introduce myself. And I literally, when I did this a couple months ago, I asked in Indianapolis, we went to one property, and I asked the person, I said, so how are things? Well, the toilet's not working, it's flooding here, and we have this. I go, have you spoken to anybody? And they said, well, it was him and Han. It was like one of those, they were afraid to say something, but the fact that I was there, I said, I own this property, I want you to be happy. If you're not happy, I'm not happy. And the woman just poured it out and told me the issues, and we addressed them. So what I'm just saying is that you can't just, sign up, buy a property, and just think it's going to take care of itself. It will not. And if you don't manage it, you are going to have issues, because they will crop up. This is not something you can just walk away with and just pretend it will take care of itself. And so it's doing the reference checks, it's checking out the property management company, see what they're like, and also if you have issues, address them with the property management company. And I'll be honest, I've had issues. Nothing's been perfect, and I've worked with the property management companies to address those issues. Some have been taken care of, some haven't. But the point is, you've got to be outspoken. You've got to be demanding of what your requirements are. They'll work just as hard as you want them to work, because they want you to be happy, and you want to be happy. So those are some of the things I just highly encourage that you take a look at.
And again,
Consider.
as I had said earlier, property managers have things happen to them too. And in this case, I think I know what you're talking about, and his mother is dying from cancer. And so he's distracted. He's distracted. And you have to stay on top of that. And when we find these out, and like I said, we have somebody now helping us to be proactive here, that we have alternate wonderful property managers. They're just, when they're mom and pop type operations, things happen. And so, he was great, and then he got distracted. And he'll be great again, but he's going through a hard time. So, all right, thank you. Thank you, it's great.
So for due diligence, I think there's several steps. First is just understanding what real estate entails when you're going to start get involved with investing, and understanding the tax advantages, the appreciation, depreciation, and some of the associated tasks, whether it's going to be you or you're going to delegate it out, such as record keeping and reporting the taxes at the end of the year, and having a basic understanding of what that entails. And then once you solidify, answer all those questions, yes, I can do this, this is passive, relatively passive, and then you move forward with real estate, and then you pick a team. You come do a few seminars, get on Real Wealth's website, watch some of the recorded webinars there, and just do a comparative analysis. Look at some of the different teams speaking, and you'll if you're not sure about this one, and compare to two or three others, and just from there solidify who you want to work with. But pretty much make sure that it's somebody that you can see yourself working with long term, and you'll being able to pick up the phone and get your questions answered. And once you've got to that point, I think that's a good starting point.
So just remember, investing is not about sticks and bricks, it's about people. So who you pick is important. It's almost as important as if you're going to pick a mate. Because this person you're going to be married to for the life of your investment. So you better like this person. And liking the numbers is one thing, but those numbers could change. And you have a relationship that's going to hold that together. From the due diligence standpoint, we took a lot of time, although it looks like it was very quick. I was like drinking through a fire hose. My wife was feeding me so much information so fast. I come home and she was just... It was brutal. It really was. I think I got a degree in getting beat up. I don't know. We had a lot of passionate conversations about what we did want to do, what we were comfortable with, what we weren't comfortable with, but we didn't invest until we were both on the same playing field. We had to agree, because this is an investment we had to agree with. From the time we started, we knew nothing in December, and by June we were buying 6 houses. But just because that time frame looked short to you, we probably condensed about a year's worth of due diligence into that period of time. So don't feel in a rush. Make sure you feel comfortable. We were comfortable. Also, know what you're investing in. So there is one, Kathy, you said something. You said you're investing in real estate, you're not investing in a commodity unless you're investing in North Dakota, because then you're investing in oil. Right? Because that's the oil industry, that's all there is. So guess what? When the oil industry goes down, I hope you're ready for the storm. And that's why we have to do our due diligence. That's why we have our reserves. Because at the end of after the end of every storm, there's what? There's calm. There's sunshine. But you got to get through the storm. And that happened during when the market fell apart in 2008, right? Those people who wrote it out and figured out how to make things happen in 2011 were pretty happy, weren't they? So we're not playing checkers, we're playing chess. You got to look past your nose. You got to look past today's ROI. You got to look past where you are today and where you're going. That's what a strategy is. And I'm all about strategy. I'm all big time a big picture guy, as she'll tell you. And she's definitely the detail that pulls me back in and says, wait a minute, they're a killer. So,
but Wayne, so North Dakota, that's gone well for you.
It has gone well, but prices have dropped. So if your workers can't afford to pay rent, what do? What's your strategy? What's your countermeasure? Well, if you can't afford, you can ride it all the way to the bottom if you want, just not move your prices, or
drop the price.
Drop the prices, because there's so much margin in those properties when you purchase them. They're still cash flowing. They're not, ridiculous anymore. But that's okay.
But they're still pretty good, and dropping the price by $100 or $200 a month is better than having 2 months vacancy while you hold firm on principal and lose way more.
That's right. So we're real estate investors. We're not, we need to have a strategy on what feels good, and when things go bad, you better have a strategy. And if you don't have one, you need to be able to get with your people, scratch your head, and you know who came up with the idea of dropping my prices? It wasn't me. It It was my manager who gave me a call. And he said, hey, Wayne, this is what's going on. And he wasn't going to do anything without my permission. I said, absolutely, drop it. What do you think it's at? And he came with one idea, and I said, you know what? Let's try this first. Let's make them say no once, and then we can always drop it down. So I had a basement number, and I had the number that I was asking for. And they did. They went for the number I offered them. So, yeah, I know, happy day. So I made them happy, because I mean, we like deals. So if I dropped the price, that made them happy, and they stayed. And they were good renters, so I retained good renters, and that's what this is all about. It's about people again, did you notice that? It's not about sticks and bricks, it's about people.
That's great advice.
And then one thing I'd like to add, you mentioned that picking a property manager, Wayne, is kind of like picking a mate. The good news is you can divorce your property manager, and the rules are all no fault. It's no fault divorce in all 50 states. So we can get out and find a new one and hopefully be happy with them. But if we do our due diligence, we won't have to do that.
All right, Ben. Well, Ben has been very active in screening since he's been with us for a year and has helped with Real Wealth Network's due diligence. But let's start with your personal due diligence on before you worked here and when you were just buying through the network, why you chose those markets.
Well, my due diligence was not nearly as good as it should have been. I now realize that, I did a few things. I mean, I talked to a few people, but I did not check references and go around and do some of the things that I tell people to do now and I do myself now. But I did a few things. I made sure that other investors liked who it was, and I knew in the case of my Arizona properties, I knew that they were kind of dipping down, and just the idea that I could buy something that's $78,000 for this is 1993, for a 3-bedroom, 2-bath house in Tempe, Arizona, and I only had to cough up $7,800 was really appealing to me. So I went to a couple seminars from the respective real estate people that would come up here, or I would go down there, and I echo a lot of what Walt says, that the chemistry is so important. I liked the people that I was listening to. My BS meter was not pegging, which is always crucial. They seemed genuine, they knew what they were talking about, they had a track record, so I just kind of went with my gut feeling, more so than I would today. Today I would go with gut, but also trust but verify. But it turned out okay, for the most part, it really did.
Okay, well, I will just share my horror story then with you, because we've seen this actually happen a lot with our Australians in particular, I think, because our Australian group is so trusting. They're so very trusting that they have at times just literally said, hey, I've got money, can I just wire it to you and you find me something? It's serious. It's amazing. So like I said, what has happened in the past is we might find a team that we really like. They pass all of our tests, and everything looks good. And then because they've got a good track record in that, and then they're getting busier. It could be that they're just getting too busy to be able to pay attention to the detail that they used to. Or, in some cases, we've actually found that it just got so easy because our investors were so trusting because of the track record that our investors stopped doing their work.
Yep.
And I'm one of them. Me. So even though I've seen this and so forth, one of our affiliates who's no longer on our list. So this is really important. I cannot tell you how important this is. If somebody's not on our list, please find out why. I can't legally tell you names in a broadcast kind of way, but you can call and ask us, why is this person not on the list, or is there something I need to know? Even if somebody's been to one of our events more than 6 months ago, before doing anything, please check in with us, because it might be that market shifted. I mean, we just had Virginia out, and that's a great market, but it's sold out, And so now the properties that they're selling in Virginia are not necessarily port properties. They're college properties, and they're not near the port. So you might not realize that. And so just check in with us, because markets change so quickly and people change. So with this one particular market,
it's okay. It's a safe room.
He told me it was a great deal. He told me it was in great shape, and guess who didn't get an inspection? Isn't that awful? Because who would want to sell me a bad property, right? That's a bad idea. That's such a bad idea. But they did. They did. So this is like, just understand, if so many people trust me and say, hey, if Kathy invested there, it must be great. And I'm here to tell you that I invested and I got burned really badly. And I'm saying this is only a few months ago. This is like a new thing. And I'm totally being authentic here and letting you know that somebody who has been in front of this group and has presented to you, not recently, sold me a property that has been red tagged and has to be torn down. Now, the one thing I want to let you know is that one thing I did properly was the contract. And the contract was described to the state and condition it was supposed to be in, which it's not. So, but I wouldn't have to be in this place telling you, you know, that even in a situation like this, you know, people can change. And I don't know what happened in his thinking. I don't know, you know, he didn't check himself. He didn't do his due diligence. Whatever happened, Rich, my dear, lovely husband, is now partners in a horrible property. So, but, you know, so if that one step had not been missed, so this, I can't emphasize it enough, even if you trust somebody, even if it's your own family member, friend, in this case, friend, and somebody who desperately wanted to be in front of you, that should have taken care of me, didn't. So you just don't trust anyone, and I mean trust, but verify and do your homework. And your homework includes, if you don't get out there to see the property, which would be first choice, because every property has a different feel. You know, you kind of just know, like somebody else might think a property is fantastic, and you go and see it, and you're like, oh, I don't know, you know. So just, it's a good idea to go see it. But if you can't, then you sure better send someone else. And that's easy to do. Inspectors are everywhere. There are associations for inspectors. We have lists of inspectors. It's very easy. You could get someone to go walk through your property and look at it. And I tell everyone this. And then guess what? I didn't do it. So, so here I am. And it's going to work out and it's going to be okay. But I tell you this because I can't stress the importance of understanding that that a handshake's not enough. Not in real estate. And not with someone that you trust. Even if they've done, and actually in this case I had bought from them before and it went great. They're one property that's really been performing well. So it was a really oversight on his part. Now, on another situation in Kansas City, I mean on both our parts, right? In Kansas City, I had somebody who I think really genuinely wanted to take care of me, wanted me to brag in front of me about how great they were. And I've got this great deal, and he really, I think, was sincere. And this time I did go out and see it, and I just didn't like it. It just wasn't.
This was a long time ago.
This was a long time ago, and in that case I just didn't like it. Now if I had done an inspection, it probably would have come out fine. It probably would have rented well. But there was just a weird layout and so forth. So if you can get out there, great. It's not. I travel all the time. You can get out to these markets in 3 hours. You can do it all the same day. You can certainly do it in a weekend. And it's worth it. If you plan in advance, it can cost you $300 or $400 to just get out there, check it out, and come back. But if you can't do that, you make sure someone else does.
So,
Right.
Can we tell horror stories without scaring people away?
No, because this wouldn't be a horror story if I'd done my homework. That's all I'm saying. It's just, you don't have to lose money if you follow the rules. That's all I'm saying.
Yeah, I just want to add one thing that I didn't mention that I think is really important. It has to do with on the due diligence side and with inspections, and that is, you know, if you're working with an affiliate and they are going to be the management company and whatnot, go and get an independent inspector to look at the property and not the inspector they're recommending. And there's a reason for it. You don't know what the relationship is of that inspector with that particular affiliate. And the reason I say that is, what you don't want to find out is the inspection comes back looking great, and then you own the property, and it's raining, and guess what? It's flooding in the basement, and they don't have a sump pump. What do you then do? Well, it's because the inspector didn't catch it. They didn't realize that the water was draining into the basement, even though the drain pipes. I'm not saying that happened to me, but my point is that it's kind of like do your due diligence and get an independent inspector to check the property. And to Kathy's point, it's like $300 or $400, and when you're spending, $100,000, it's chump change. Plus, you write it off anyway as part of your expense of the purchase. But it's like anything. There's other things that, that I honestly, would say you can leverage, and that is like with Missy, I got property insurance, and she said, you know what? I can put you under my umbrella property because I got a huge discount, and I did it because the property insurance it's insurance. It's a whole different thing. An inspector, they're inspecting a property that you're buying. So you got to just do your homework. And again, the other thing I kind of reinforced, talk to other members that are in those areas. Talk to them. Find out what's working, what's not working, what was I gotcha, a surprise, I didn't anticipate this. But the inspection piece, if there's anything you do that. If you don't do anything else.
Yeah, there's 2 websites that have certified inspectors on there. We give that to you so you can pick out independent. Sometimes the inspectors recommended to us by teams are good independent inspectors, licensed, bonded, all that, and are required to follow the law. But we have seen sometimes companies, certainly not on our list, but other companies that would have in-house inspectors who work for them. So you're not getting a really legitimate inspection. But yes.
And the inspectors always find something. I mean, I have affiliates that I would put at the very top of the list, and I would highly recommend it. Do a great job with everything, but the inspectors will still find things.
Which the affiliate will then
exactly.
So it pays for itself.
Yeah, and you just would never know that stuff. Another thing that is a good safety valve that bailed me out of a bad situation once is the appraiser. I went under contract to buy 2 properties, and everything looked fine to me. I was paying like $120,000 for each one of them. But when the appraisals came back, they only appraised for like $91,000. So if I was buying something for $120 and it came back $118, I wouldn't have worried about that. But it came back in the low 90s. And so, I'm living here. This other city is across the country. I don't know what stuff sells for. That's the appraiser's job. That's what they do. And the bank doesn't want to loan you money on something that's not worth it. So the builder who was selling me these 2 properties didn't want to come down, and
So you just
walked away
So
from it.
this is new construction?
No, it wasn't. I said builder, but
Okay.
I
But
meant
it-
builder.
You walked away?
Yeah, I walked away from it, and it was easy to do. And what I think this particular guy was doing was just milking the market. He said he wasn't at all upset by the fact that I walked away from these 2 contracts. He just said, I know I can sell these. I don't have any reason to come down in my price. So that's the problem with buying stuff sight unseen and not having experts look at it, is that you don't have any way to know.
And that's why you've got a checklist. Your inspections, your appraisals. In this case, it could be that it was a bad appraisal. So then maybe you go get another one. It could be that they really saw the value, but the other comps were foreclosures. There's a lot of reasons, but the bottom line is at least you have the data and you can make a decision.
And usually I would probably advocate getting a second appraisal, because when I did fix and flips, we had many deals just be torpedoed due to a really, really ridiculously low appraisal. Like, they didn't consider what I would think would be really basic things like gee, we just renovated this house and you missed that comp, that you used this foreclosure and this REO, and that's how you came in low. So you would get another appraisal and then it would be okay. But sometimes you should walk away, absolutely.
Yeah, I mean, if there's any question or if it creates mistrust, then you walk away. But that is definitely a problem with appraisals these days, is that appraisers make about half of what they used to because of new regulations. Half the money, you're like, realtors in the room are like, we know this, because government regulation has now taken half of what you pay in appraisal into an organization that monitors it all. And so appraisers are getting half. And so they're kind of, in a lot of cases, doing half the work. And so we've seen appraisers literally not even go to the property, and or do comps that they just pulled up really quickly and didn't even check to see that one was renovated, one wasn't, one was on a busy road, one wasn't. So it doesn't necessarily mean that, you know, in this case, the seller was like, this is what the property's worth. If you don't think so and the appraiser doesn't think so, that's fine. And that's fine with you to walk away. He felt it was the value.
But the other thing has also happened to me where I've gotten a low appraisal. And I knew right off the bat it didn't make sense. I was buying two identical houses, new construction, but one was on the corner and one wasn't on the corner. So the guy went out to appraise them, and he saw two houses the same, and he gave them the same value. But I was paying $10,000 more for the corner lot. And the bank said they didn't want to lend me the money. I said, well, what if I paid the $10,000? They still didn't want to lend me the money. So all we had to do is point out to the appraiser that they weren't the same property, and we had no problem changing it. So that, you know, that happens too.
Good. And that's what we're here for, is when you have questions that you're not sure about, you just bring them to us and we'll take a look. All right, well, we're going to take a break. It's been, I think our breaks only can last 90 minutes or something like that. So we're gonna, and maybe other parts of us. So we'll take a break, 10-minute break, be back in 10 minutes, and we'll do the second half. Thanks, everyone.